Michael Gurka of Chicago-based Spectrum Asset Management is on the show with us this Monday morning. Happy Monday to you, Michael.
Well, thank you.
Well, we have a lot coming from the Fed this week, the Fed minutes and the big Jackson Hole meeting with the Fed heads. Will that hold the market in a pattern today, a holding pattern?
I don't think it will. Actually, I think the anticipation that this week's meeting and let's just put it this way, a lot of vernacular is really going to add to more volatility in the market. And of course, we're looking at 10-year Treasury yields in particular as they breached 280 and showed us at least that though the growth of the country might be stalling on Main Street, the markets believe that something's alive because we started to see a downward pressure all of last week. And it was reciprocated, of course, by the way the stocks traded along with that.
Those treasuries are at a high we've not seen since 2011. Can this persist?
I think we will see more of that, but to the point that the fulcrum has already been surpassed. So that point means that I think that 3% might be out of the cards for now. Pullbacks might be short, but this could be the new pendulum for where the market starts to swing at these higher rates. Remember, historically, these are still very, very low rates, but coming from where we were, it was a one heck of a percentage turnaround.
What do you predict will happen with the dollar this week?
I think the dollar will continue to remain weak. We watched the euro and the British pound in particular really gain for most of all of last week. And I think the strength that we're seeing in European currencies as a whole have a lot more room to the upside. And the Fed has a bias on a weaker dollar. And that's not just because of export trade. It just seems as though the Fed has always had that within the last decade or so. That's one of the reasons why I would not look for this to stop.
Michael, thank you for spending some time with us this morning. Have a good trading day.
Thank you.